Right, welcome to FMGT 3224 Lecture 9, Part 1, where we are going to focus on relevant costs for decision making. This is Chapter 9 in the textbook. And the whole idea here is there are times when you will be presented with decisions to make based on financial information, and they won't be quite as obvious as it appears at first glance. There's some classic ones that we're going to explore in the course of the lecture, but the bottom line is to give you some tools to make appropriate decisions properly and intelligently, as opposed to incorrectly, which is the way it would appear to, that would look correct at first glance. Okay, so when we talk about relevant costs for decision making, really what we're looking at here is what is relevant to consider in a decision and what is not. And if you look at the book, they'll talk about relevant cost being a cost that differs between alternatives. Yep. Then they'll talk about the differential cost, in other words, the difference between the two alternatives. And they'll run through concepts like avoidable costs and so on. We'll talk a little bit more about those as we kind of go along. But the general rule for this kind of a problem is a cost is relevant. In other words, you should consider the cost in your decision if it meets two criteria. One, if it differs between the alternatives. So this says two alternatives, but really it could be whatever the number of decision alternatives there are. And it's a future cost. It's a cost that will be paid in terms of cash outlay at some point, or revenue coming in at some point in the future, not a historical cost. And you'll see what we mean as we progress. So what you'll often see is things like sunk costs get brought into decision calculations when they shouldn't be. Costs that don't matter. If you choose A or you choose B, and in either case you're going to have to spend $10,000 to buy a part, then it's not really a relevant cost, because no matter what happens, you're going to have to spend it, right? So it's relevant, but just not relevant for the decision of whether you do A or B. So let's look, generally speaking, then. We'll start our analysis here with sunk costs and an explanation as to why sunk costs are not relevant. And so in this example, White Company, a manager at White Company, wants to replace an old machine with a new machine. So we look at the numbers here. The new machine is going to cost $90,000. It'll have annual variable costs. It'll last 5 years. Okay, the old machine, the original cost of $72,000. The remaining book value of $60,000, disposal value now 15, annual variable expenses, and so on. So as we look at this, some of these costs listed are relevant for the decision, and some aren't. Think back to those two criteria. It's got to be different among the two alternatives, and it has to be a future cost, not a past cost. So some other information here. White sales are $200,000 per year, and fixed costs other than depreciation are $70,000 per year. Okay. Should they buy the new machine? Well, so this is the wrong way to go about doing it. We could look at things and go, okay, well, remaining book value is $60,000, and if we sell it, we're only going to get $15,000 for it. So we will record on our books a loss on disposal of $45,000. And who wants to show a loss on their income statement, right? But this is not the right way to examine this kind of analysis. You may or may not show an accounting loss on the disposal of the machine, but that, as we'll show, this loss will appear regardless of whether you keep the machine or not. It'll just be in a slightly different form. So the right way to look at it would be to compare keeping the old machine and what the effect on net income is, as well as or comparing that against buying the new machine and looking at the effect on net income that has. So if we keep the old machine, we're going to have sales of $1 million, $200,000 per year for 5 years, and variable costs of $500,000. We've got some fixed expenses, $70,000 per year times 5 years. the amortization on the old machine over the course of the 5 years is going to be $60,000. Now, let's look at the new machine. Sales, also $1 million. Okay, so hold on. If we have the same cost that doesn't differ between the two alternatives, it's not relevant for the decision. So in fact, we don't even really need to look at sales in this case. We're going to, but we'll take another look at a simpler and more elegant way to approach this problem in a second. So the variable costs go down. That's good to know. And other fixed costs don't change. The amortization or depreciation on the new machine is there, $90,000. And now, here's the interesting thing. Even though if we keep the old machine, we're going to record depreciation or amortization expense of $60,000 over the rest of its useful life. If we dispose of it, we're also going to record a $60,000 essentially loss as we write down the book value of that machine. So whether we spread it out over the 5 years or we record it all at once on the disposal of the old machine, that $60,000 is going to be recorded as an expense one way or the other. So it is not going to change. It's not a relevant cost for the decision because it's the same among the two alternatives. And finally, the disposal of the old machine, that is in fact going to generate some a cash flow because we're actually going to get paid when we sell the old machine. So that is a relevant cost for the decision. Okay, so now as we look at this, the effect on net income shows that the new machine would bring in a net income or would contribute towards $115,000 towards net income, and the old machine only $90,000. And so the difference, acquiring the new machine, essentially increases or improves our net income by $25,000. Now, going back to what we were talking about, the way to look at this in a more elegant way is to look only at those costs that differ between the alternatives. So the variable expenses are different. $100,000 to the good if we buy the new machine. The amortization expense on the new machine is going to be a $90,000 expense. So no, that one's not. Sorry, that one is relevant because it only exists under this one alternative. And the other one is the proceeds from disposal of the old machine. So if you look at those costs, you will come up with exactly the same answer, the fact that you're $25,000 better off to purchase the new machine. So I think we're just about to explore what I've just finished telling you about, that yes, the more efficient or the more elegant way is to look at only those costs that are different between the two alternatives, ensuring of course that they're future costs and not past costs, and that will lead you to exactly the same answer. So let's take an attempt now at brief exercise 9-2 on page 412 to see if we can employ this in make this practice work. All right, so brief exercise 9-2, page 412. We've got Waukee Railroad. They're considering the purchase of a powerful high-speed wheel grinder to replace a standard wheel grinder now in use. Selected information on the two machines is as follows, and we're now asked to prepare a computation covering the 5-year period that will show the net advantage or disadvantage of purchasing the high-speed wheel grinder, and we're asked to use only relevant costs in our example. Okay, so let's see. We've got the standard one and the high speed. The original cost new of the standard one is totally irrelevant. That happened in the past. It is completely sunk. But the cost of the new one is relevant to us because it occurs only in one of the two alternatives, and it is a cost that would occur in the future. So $52,500 would be the cost associated, or one of the costs associated with acquiring the new grinder. Accumulated amortization on the old one so far, totally irrelevant. Current salvage value, so what we could sell the old one for, because that is only going to happen in one of the two alternatives, that of getting the new grinder. It is a relevant cost. So it is, now I'm going to make that negative because that would be cash going out the door. Current salvage value would be cash coming in the door, $15,750. That would be to the positive. Estimated cost per year to operate, $26,250 for the old, $12,250 for the new, over the remaining useful life of 5 years. Okay, so operating costs over the lifetime. Now, ideally, if we had a discount rate and everything else, we would treat this as a series of discounted cash flows. But interest rates are low right now, and we also don't have that information. So, and bear in mind, we're teaching this to you now as a concept. If you're going to apply it in practice, obviously you would look at that and go, well, it's cash flows over a series of years, therefore we have to discount them to the net present value and so on, right? So operating costs over lifetime, $26,250 minus $12,250 times 5 years. That's $14,000 per year times 5 years, $70,000. And I think that's it. We add it all up, and I get $33,250. And therefore, yes, we should. Yes, buy new grinder. All right. So that was our quick and dirty demonstration of relevant costs for decision making. Now, one relatively common decision is, do we keep or do we dispose of a business unit, a segment of our business? And relevant costs will factor into a decision like this in ways that you'll see, largely due to the fact that often you'll have corporate costs or other costs from the head office that will be allocated among the divisions that won't disappear. If you get rid of the division, the costs aren't going to go away. And so those would be considered non-avoidable costs in this case. And those are the ones that will trip you up and make it look like you ought to get rid of the product line or the business unit or whatever, when in fact you're worse off if you do. So let's take a look at the Lovell Company's digital watch line. It hasn't reported a profit for several years. We've got an income statement right here, and as you can see, it shows a net loss of $100,000. And as we go through here, we've got variable cost, commission, contribution margin, all that good stuff. General factory overhead. Wonder what that is. And so on. Depreciation of equipment. Didn't we see in our last example that depreciation often, certainly of old equipment, is not a cost that differs among the alternatives? So not sure that cost is going to go away if we get rid of the this business line and not. So there's a number of things out here that make this worthy of additional analysis, let's say. So now we get a bit of information here. Investigation has revealed the total fixed general factory overhead and general administrative expenses would not be affected if the digital line is dropped. So what does that mean? General factory overhead, that $60,000 is not going away, right? And what was the other one? General administrative expenses. This one here, that $30,000. So almost $90,000 of this cost is not going to disappear if we get rid of this segment. So right away, although we're losing $100,000, $90,000 of that's not going away. Now, if that was all there was, we'd still potentially be better off, but it looks like there's a bit more information here. What else do we have in the next slide? Equipment used to manufacture digital watches has no resale value. Okay, now that goes back to that depreciation piece. So question there. So the question before us is, should they retain or drop the digital watch segment? And we'll address that in part 2 of the lecture.